Good morning, Hex fam. This is the chart set video for the crossover of August 9th into August 10th at 0000 UTC hours. Let's get to it. As always, a little disclaimer, information displayed in this broadcast is known to cause increased amounts of FOMO. Lowe's only is alone and is not responsible for your piss poor staking strategy. You must remember how the math works, folks, because this is what ultimately happens. We've been seeing it since Big Payday. It's not going to stop anytime soon. So you might as well get used to it. Let's just get into what an economy is. An economy is a complete ecosystem that has two participants: value creators and value detractors. Simple as that. In our version, it is the private sector that is the value creator, and the public sector is the value detractor. The public sector is there to facilitate civilization, so to speak, aka help us live cleaner, better, more fulfilling, less stressful lives. If you take a look at what's going on outside, you can clearly see that not only is that not the case, but the bigger issue has become that the private sector has been reduced in size due to the fact that the public sector requires more and more financial support. And what that typically leads to is a detraction in value creation and opportunity for the private sector, which is the actual value creation nexus of every economy, regardless of the level of the economy, whether it's your local economy all the way up to international economy, right? Those that are selling goods and services or producing goods and services are the reason that economic activity happens in the current economic system that we have. Everything is taxed, and it's taxed for a supposed purpose, and this is where the public sector comes in. Now, the reality is that they clearly take more than 30%, which is what has reduced the value making portion of the pie of all economies across the world, which is why everything is in the current state of affairs that it's in now. So it's basically on you as the private individual to stand your ground and understand what's going on in the economy, because they're trying to de-weaponize you financially, in case you haven't noticed. This is what the debasing of the currency, fiat currencies, are all about. It's not a coincidence, it is by design. So let's get into Hex data. Market cap dominance for the top 100. We are not looking as great as we were. This was for 7:30, approximately 10 days ago. We were at 4.5% roundabouts, up to 5% on the 2nd of August, down to 4.66% on the 6th, and we are down a whole percentage point since then to 3.62. As you guys have noticed, we have a lot of sellers exiting the system, which is great, because all that's going to happen is that if they attempt to come back in the future, clearly they don't know what the hell they're doing because they're selling in size and putting themselves at a disadvantage when exiting the system. There is a way to enter and exit the system without leaving a footprint. So either these folks are stupid, trying to push the price down, or just ignorant. I don't know. So go figure. Can't help them all, right? Um, Moving on. So here we have a chart displaying the first 602 days live between Bitcoin, Ethereum, Hex, and the T-Shares index. They're all in indexed form. What I've also thrown on here is a trend line to display the return nature for both Ethereum and the T-Shares index, which is the value proposition for Hex, and we'll get into that. But Bitcoin, as you guys can tell, didn't really lend itself to any trend making on this chart. Now, if we're looking at this index, these indices, what we're going to notice first off is that Hex and T-Shares are significantly outperforming Ethereum and Bitcoin. Now, again, this is comparing return activity since inception. So if these were human beings and you were looking at them in terms of size and age, taking into account that they're all the same age, T-shares would be the tallest, Hex index would be second tallest, Ethereum would be less than half, right? Like a quarter of the size. Or was that tenth of the size? No, less than a tenth, right? 4 divided by 50 or 60, so whatever that is, right? And then again, same deal with the Bitcoin index, right? It's dwarfed 60 to 1, basically. So that's what's going on. Outperformance on levels that can't be understood by most, and this is what you own, right? If you own Hex. And the most important thing to realize from this chart is this trend line, which is the trend line for the T-shares index. Now, the important thing to realize is that the longer you hold this trend line, right, the higher the value is going to be at the end of your tenure. It's very simple. I've been holding this trend line from back here, basically, and it's all the way up here now. So the question is, how long are you willing to hold it, and how high are you willing to watch it go? That's pretty much how this works. It's how it worked for Bitcoin. It's how it's worked for Ethereum. I don't really see it working any differently for Hex, given that it's only 20 months old. 13, 12 cents. Nobody knows about it. It's gate kept, and it's still outperforming everything. So what's going to happen when people, or more and more people, realize that this exists? Because you can't hide it. People are finding it, especially every time that there's a down move in the promised coin space. So this is what this data is displaying. You must understand it. Check out my website, willsonly.com / charts. That's what these images are housed for now. Hex post big payday is 264 days past that point in time. Big payday was a singular event, one-time event that essentially pushed out 189, 190 billion coins into the system, which at the time was approximately 30% of the remaining supply that needed to be pushed out in order to finalize the launch phase. And what we saw was a run up into November 1st, and then a sell off into November 19th, 2020, which was the end of a launch phase in conjunction with Big Payday. And once Big Payday occurred, people thought that they were being slick or something, I guess, cashing out at the lows after getting a 30% bump in your coins. But clearly not smart after all. I mean, they maybe exited at about 1300, maybe 1450 to be gracious and generous on the index value. I mean, clearly dumb. And as we're looking at the performance since Big Payday, right? Everybody's missed out on a 2,000 point move on an index basis. Whoever sold at that point in time. So good job, guys. It's how you really show them how to trade, right? And this again just goes to show less is more. And the key to success in allocating capital is letting the market do the work for you. It's not clicking your life away. So it's important to understand. And this chart is highlighting that, right? We saw what price did into that pre Big Payday period of time, and then into Big Payday, and then what actually transpired thereafter, given that the inflation worked itself out over time, right? Which is what we're seeing here in the sideways action and in here as well. And all we have now is up and to the right. Right now we're getting some heavy selling because certain actors are exiting the system, and that's okay. That's exactly what we want at these price levels, because the quicker we get the duds out, right, the better off we all are in the long term. And that's just the nature of the beast. That's just the nature of the beast. So that's the important thing about this chart. We'll move on to the next one. All right, guys. So now on to the T-shares to Ethereum and T-shares to Bitcoin chart versus Ethereum is the pink chart versus Bitcoin is the orange line. Sorry, pink line, orange line. And what we'll see is that we've retraced quite a bit from almost 200%. As you guys can see, T-shares to Ether on the left side, and T-shares to Bitcoin are on the right side. And we almost tagged 200%, right? We went, I think, as far as 150, maybe even 170%, versus Ethereum at one point. And as you guys know, they've been pumping the crypto market. And this is why we've been getting these downdrafts in value with respect to T-shares versus Ethereum and Bitcoin. And that's just basically what's going on. But big picture, right? T-shares are sustaining their value, and that's what matters. Because we get paid every day, so the value is accruing over time. Important we remember that. Here is the hex stock to flow tracker. Of course, it's dynamic. You can't forecast it out, given that we cannot foresee the future as far as staking goes. And as of last night, the dollar cost for a T-share was $2,399.66, while the cost of 10,000 hex was at $1,293.74, which led to a T-share rate of 18,548 hex per T-share, all while the system yielded a 38.07% APY yesterday. So where does the T-share rate come from? The T-share rate comes from the dollar cost of a T-share being divided by the dollar cost of hex by 10,000. And this closed system is what allows the T-share rate to determine the value of these two mechanisms, because what happens is as stakes end, and we'll get into how that impacts it specifically shortly, when stakes end, it ratchets the T-share rate up with respect to two factors: the size of your stake and the length of the stake that's exiting the system. The longer the stake, the more ROI that there's probably going to be in the stake. The bigger the stake, the more T-shares that are going to drag through the system on the way out, right? The more T-shares that are going to be burnt. So that's going to also have an impact on what the T-share rate is on the other side of that stake being ended, because it is a mathematical computation that yields this T-share rate, right? And it's important we understand that. And that is a function of end staking. The APY is a function of the staking, right? And the end staking. So what do I mean? We'll see exactly what I mean once we get to the end of the slideshow. But long story short, if the staking percentage for the coin goes above 10%, meaning from 9 to 10 to 11, then what happens is the APY will be reduced from 38% where you see it now to 36.9 and further, right? Down even further below, and we'll see that shortly. So here we have the value proposition chart, and this is just when we see hex versus the payout per T-share sum line, which is all of the hex that has been paid out in cumulative sum for each T-share in the system. So if you have 100 T-shares and you've been staked since day one, then you have 2,512.64 hex multiplied by the number of T-shares you have. Not a little bit, a whole lot. So that's a very outstanding performance from a system that is designed to work how it actually works. It's almost crazy, but it's true, right? It works how it's designed to work, and this is what we see. We don't see any blips or discontinuities in the data for that reason. And what we'll note is that over time, price is pretty much just tracking this, right? Because again, this is the value proposition. This orange line is why people buy and stake hex. So the price is designed to literally track that, because this is always going to be true. And now this is the indexed return form of, of this data point. So this is the cumulative sum of that figure, right, of this metric. This is that metric indexed, so in percentage form. So if you've been staked since day one T-share, you made 227,000%. Congratulations. Pretty phenomenal. This is the power of staking. This is the power of doing nothing, right? This is the power of letting your money work for you And it's important to understand that power. Payout per t-shirt index is giving us a read of 529. And basically what this is saying is that the payout per t-shirt has increased 5x since inception. Daily payout index is giving us a read of 17,291, rounding up, which is basically saying that the payout system, that the daily payout has increased 172x since inception. Now, the whole point of these two lines is for folks to go on ahead and show me another system that is claims to be proof of stake that pays out in such a consistent manner. Consistently, the system does this. There's no volatility here. Consistently. All right, here are the Hex Payout Metrics. And what we're seeing here is the total T shares in the orange line, which we're currently sitting at 10.978 million trillion shares. Daily payout at 64 million hex, which yielded a payout per T share of 5.837 hex. So if you have one T share, you got 5.837 hex yesterday. If you have half a T share, you got that number divided by 2. Right? If you have 100 T shares, and you got this number multiplied by 100. And that's how it works. Okay. Here we have the everybody gets paid chart, and what this chart is essentially highlighting is different variations of the payout per T share in average form. We have the all-time average here, basically 4.1 hex per T share. Payout per T share, and we have the 28-day average at 6.12 hex, and the 55-day average at 6.02 hex. And as you guys can see, these values are going to change over time, right? And the important thing is that we're going to see is how price is going to react, right, to this value change over time, because we just don't know, right? We can presume based on what we've seen, but we only have 600 data points to go off of. It's really not that much, because 15 years is a lot longer, right? And that'll definitely give us a clearer picture of what this does. Not saying we're going to wait 15 years to figure it out, but I'm just making an example. 600 days is nothing in the grand scheme of what a data set is telling us, and that's kind of the point. Alright, so now we're looking at the expiring shares chart, and the importance of this chart is just to realize what's happening with the staking, right? Because again, the end staking, or I'm sorry, to see what's going on with the end staking, because the end staking is what drives the T shares up in value, right? As we discussed earlier, the T shares recalibrate at the end of a stake by a function of two things: the size of the stake and the duration of the stake, right? The impact on the returns from both of those arguments within the function are going to determine the impact on the recalibration of the T-share system, or the T-share metric, right? So if it's a long and a sizable stake and the ROI is pretty significant, well, the T-share rate is going to ratchet up pretty high, pretty significant. So that's how that works, right? So as we can see here, the last day of July, we had a reading of about 28, or the day before the last day of July, about 26, 27%, while August was already pretty much at 44%. And then when we go to the 2nd of August, we pretty much see it's kind of the same, but no longer July. But just note, right, the slope. Note the slope and if there's much change, because that's how we see these things. And as you can see, from the 2nd to the 6th, there was an increase in that slope, meaning there's more short stakes in the system, right? And the importance with understanding that is that means that the T-share rate is going to keep getting ratcheted up, right? That's the important thing to understand there, which means that the share rate is going to continue to get more expensive over time, right? And the system is designed to work that way. And that's important to understand, because if we look again, right, from the 6th to the 2nd, we see increase, increase, and increase again, right? It's just about finding what that increase is. And that is always a function of just relative change, right? So as we can see, August is still at 45% or so. September is at around 28%. October seems to be right at about 17, 18%, right? And what's going to happen is that over time, these values are going to keep shifting down, right? The value here is going to decrease, the value here is going to increase, and the value there is going to increase. So it's just going to be a transference, a value transfer in terms of staking from the front to the 2nd to the 3rd to the 4th, and so on. And that's what I'd like to help people understand. And that's always what's going to be driving the T-share rate to go up. All right, what we're looking at on this chart is the all-time Hex versus Ethereum correlation and the all-time Hex versus Bitcoin correlation. Bitcoin, Bitcoin, Ethereum, Ethereum. And the important thing I want to highlight about 3 items on these charts. First is that each data point is a representation of the return from that point in time, that date between Hex at 65%, which is the X plot, and then Ethereum or Bitcoin, right? In this case, 24% minus 24%, which is the Y plot, right? And that's what we're seeing for both charts, right? X, Y. X here is probably about 10% for Hex, maybe 12, 15, and minus 8% for Bitcoin, for example. Right? That's number one. Number two is that the chart is giving you the all-time correlation, which is 0 for both. Okay? So over time, no matter how correlated things get, for a small period of time, the true reality is that they're always decorrelated and they move in their own way. Number two. Number three, note that the groupings of the hex returns is to the right of its x-axis, whereas the returns for Ethereum are kind of spread out and in fact are mostly below the 0 line of its y-axis, meaning the preponderance of the returns are negative, whereas the preponderance of the returns for Hex are positive, meaning they're mostly positive, whereas Ethereum's are primarily negative. Even if it does go up over time, the volatility is there to shake you out. And it's the same case with Bitcoin. You look at the returns for Hex, they're primarily on the right side of the 0 axis, or the 0 line on the x-axis, and it's not the same for Bitcoin. And those are the 3 things that you need to take away from these charts, because if a professional looks at this chart, those are the 3 things they're going to look at, and the decision to allocate capital is going to be very simple, and that choice is going to be Hex. I mean, proof positive in your face right there, right? Hard to ignore that. All right. Here we're looking at the rolling correlations of T-shares versus Hex in dollar terms. Now, we have the dollar cost of Hex on the right side, giving us a current read of 12.94 cents. And we have the 55-day correlations, or the correlations on the left-hand scale. But we have 3 correlations, in fact. We have the 21-day in orange, the 34-day in gray, and the 55-day in yellow. Now, we track the 55-day first and foremost because that is the longest term correlation as far as duration goes. And if that one is holding up, then we are good as far as the long term goes. But as you can see here, there has been breakdown over time, right? And that leads to volatility with respect to price performance, right? And volatility within the closed system, right? Not price volatility per se, as you can see on this chart. Not much volatility there. So it's just important to understand that. Now, the overall kicker of this chart is that it's giving us a read of almost 1, letting us know that if T-shares are doing something, Hex is doing something in dollar terms, of course. And that's pretty cool, right? Because given how T-shares function, as we know, they only move up and to the right. So if this correlation, the 55-day along with the 34 and 21-day correlation, stays strong, then that means that the price will, by default, track the T-share value, which is designed to go up and to the right. So I hope that makes sense, and I hope that provides some clarity as to why holding Hex makes sense, even if you don't stake it. Alright guys, so this chart is Hex in dollar terms, payout per T-share in dollar terms, and the adjusted value of Hex in dollar terms, and this line is just a summation of Hex in dollar terms plus payout per T-share in dollar terms. Now this line is the exponential trend line. What this means is if this data series isn't true to this mathematical relation, then it can't print. So as long as it stays there, T-shares are doing what they're supposed to do, which is creating value. That's basically what that means, because This is a summation, right? And that's what I'm tracking the trend line of. So the system is always printing value, and this is what the payout per t-shirt line is giving us, right? What the yellow line is giving us is a future value for Hex. And as you guys can see, we've been printing a lot of value lately, right? And this is why there is the gap is currently pretty wide for Hex. So this typically leads to a snap in price. And we're seeing it here, saw it here, saw it here. Well, I mean, we all saw it here, right? And you know, that's to say that value doesn't stop building. Price can go wherever it wants, but the market's going to have to react to that. It's going to have to recalibrate in line with reality, right? The pink line is reality. The yellow line is where reality goes to meet what's supposed to be, right? This is what currently is. This is what's supposed to be. This is reality. So once you put all these three pieces together, or these two pieces together, right? This is what reality is, and this is what currently is, and you get what it's supposed to be. So I hope that makes sense. But this is just a leading indicator, right? The yellow line is a leading indicator. The pink line is a leading indicator, and the orange line always follows, right? And this is what we see over time. It just always follows, going all the way back to inception, right? So this isn't going to change. What's going to happen is that over time, as the gaps continue to grow, price is just going to ramp up quicker. And that's where you get these big moves from. You got a 10x here, I think, a 7x here. Who knows what this is going to be? I don't remember what this was. I don't remember what this was either. But anytime the system builds value and consolidates, X is abound. Pretty straightforward. Hex price to earnings ratio lets you know how quickly you can double your money. In this example, what we're seeing is that you can double your money within 17% of 1 year's time. Whereas the all-time low for the stock market, the S&P 500 price to earnings ratio, is letting you know that your best opportunity was over 100 years ago during World War I, when it gave you the opportunity to allocate capital and make your money back maybe in 5.5 years, versus 17% of 1 year. Choose wisely. And this is where we currently are, somewhere around here. We're probably closer to this line than we are to the middle at this point, given that so much time has passed since I've made this chart, and the growth of Hex has been pretty significant in terms of adopters and users, and it's only a matter of time before we start seeing six-figure stakers. I know it sounds crazy and far-fetched, but it's coming, because you'll see. And here again is the how the APY works, right? So the APY system is designed to pay out a minimum yield of 3.69%. Now, it's important people understand that this is a systemic design. This means that we only matter in as so far as everybody else in the system. So if we're the only participant, we're getting 369% APY, right? Golf clap for that. But if half of the system is staked, we're only getting 7.38% APY, right? Not as attractive as 369%, but better than 3.69, and the system is 50% staked at that point. At 20% staked, which is almost double what we're currently at, you got an 18.45% APY. Now, the crazy thing is that while these numbers, the low numbers anyway, sound ridiculously low, you have to look outside the system to realize that anywhere else where you can maybe earn a yield is actually lower. And if you can get higher yield, the risk is going to be significantly greater, and your return is going to be in fiat. So it's actually trash. Because with Hex, this is paid out to you in crypto. So not only are you winning based on the fact that you're getting paid out in crypto, but you're winning based on the fact that the dollar always goes down in value versus good product market fit cryptos. And guess what? Hex is one of those. So while the system is designed to pay out 3.69% at max capacity, it currently is paying 38% APY, right? And that's between 9 and 10% of the coins being staked as a percentage of the total supply. So that's how the APY works. It's not a function of price, it's a function of staked supply, right? And the total supply at that, not the circulating, but the total supply. So I hope that makes sense for everybody. If you have any questions or anything like that, let me know. You guys check out my website, whalesonly.com. Oh my God, sorry about that, guys, but you know I live in a jungle where people don't know how to freaking do anything without being obnoxious about it. So check out my new website, whalesonly.com. There'll be some blog posts on there. I'll be keeping the charts as there. In fact, that's where I showed the charts from the day. whalesonly.com/charts is the direct link for that. So yeah, you can follow me on, you can subscribe if you're watching this on YouTube at youtube.com/whalesonly. Follow me on Twitter at twitter.com/whalesonly and the number 1. Hit me up on Telegram at t.me/whalesonly. And you can also contact me through my website at whalesonly.com. Thank you guys for tuning in, and see you guys tonight on the Quant Gang.